Hello and welcome to this edition of Money View from the Top here on Daily Hunt. Joining me today is one of India's best known fund managers, one of the most respected fund managers, a veteran of the mutual fund industry. People follow him, look up to him for cues on the way markets will move. S. Naren, who's the Executive Director and Chief Investment Officer at ICICI Prudential Mutual Fund. Thank you so much, Naren. It's always wonderful talking to you. We've been talking over many, many years, and it's a good time to probably take stock of some of the principles of investing that you have been articulating over many years, especially in times like these. So my first question, Daily Hunt, of course, has a lot of young viewers whom perhaps right now, with all the volatility, with all the bad news that is coming globally, interest rates, hikes, inflation, volatile markets are probably feeling a bit of fear. What would your advice to an investor be at this point of time?
So it's a pleasure to talk to all Daily Hunt people because, it's been my first interaction in Daily Hunt. And I've always admired you, Vivek. So I look forward to this interaction. See, I've been in markets since 1989, and I've always been worried about first-time investors. And I believe starting March 2020, there have been a number of first-time investors. And they belong to the younger cohorts who must be all part of what Daily Hunt is. And they are used to channels like Daily Hunt. So they haven't seen bear markets. And, when I started working in 1989, and I saw my first bear market in 1995-96, because in 92 somehow I was too young, so I did not get in. I think the first bear market after you start investing is a pretty difficult bear market because you have ignored many of the important laws of investing. So what is the most important law of investing? In my opinion, the most important law of investing is actually don't take leverage in investing. The second important law is don't use derivatives. And if you use derivatives, you should know everything about derivatives. And even if you know everything about derivatives, I think there are very, very few people who know how to use derivatives to make money. And the third important law is don't ignore asset allocation. And what asset allocation means is basically invest in equity, invest in debt, invest in gold. It is equity is the most interesting asset class. Debt is the most boring asset class. And people think that, if you are invested in equity, you're doing the right things. And if you invest in debt, it's so boring that people say that it doesn't make sense. So that's why we've created products in asset allocation, which involves equity, debt, and gold. But people think, what is the role of debt? It's such a boring asset class. But what I learned in 94, 95, 96, and what I learned in 2000, 2001, and 2002 was these three things. Basically, don't get leveraged. Be very, very careful if you're using derivatives market, and don't ignore asset allocation, which means have a role for equity, debt, and gold. And I think if you have followed these three things, there is a fourth. I was an investment banker between 1990 and 94. And actually, I was involved in many of the IPOs in the market between 90 and 94. And, somehow IPO investing did not result in the IPO investors making money. And I believe that somehow the IPOs are not easy places for investors to make money because the IPO seller knows much more than the IPO buyer. So I would say these are the four laws I would say that my 33 years in markets have taught me, which I'm happy to share with all of you at this point of time.
Thank you very much, Naren. You talked about the importance of asset allocation. Now, tell me something, one of the big problems that investors face, especially new investors, is where do we start from? So, with mutual fund Sahi Hai campaign, all the work that the mutual fund industry, people like you, the media has done over the last 2 decades to educate people seems to be bearing fruit. We are seeing more and more people coming in and, investing in mutual funds. But the big question on a beginner's mind is, where do I start? I mean, of course, we all say, please first go to an advisor. But in today's digital age, many people, want to do it themselves. So what is a good starting point according to you? Not asking you for a scheme name, but as a category, because there are so many categories, so many schemes. What's a good starting place where I can get used to the fact of asset allocation early?
The starting point is actually very simple. In 2008, I was a fund manager in the equity side, and I watched people lose 50%. And when that happened, at ICICI Prudential, we went back to the drawing board and asked ourselves, it was so unpleasant to watch investors lose 50%. So after that, we worked very hard in creating a category called Balanced Advantage. And we've been very happy to see that it has become a category. And I believe that is clearly the starting point.
And a balanced advantage.
There is no substitute to Balanced Advantage being the starting point. The second, which I think everyone has worked over the last 25 years, and I would not say that the entire mutual fund has worked on, is SIP. So that is, I would say, the second, if you ask me. The third, which people have not worked on enough, if you ask me, is the role of debt mutual funds. Because, the kind of frameworks that have existed somehow always went into looking at credit risk. Actually, there are such interesting categories like, short-term funds, you have savings funds, you have dynamic funds, you have these kind of funds, you have, we believe that this kind of debt mutual funds, medium-term plan funds, etc. I would say that is the third. You don't need beyond them as a starting point. So my view is Balanced Advantage as a category, SIPs as a category, and debt funds as a category. And I would not certainly start with gilt funds. I would not start with credit risk funds. I would not start with long-term bond funds as a category. Almost everything other than these in debt, I would say is a very good starting point in debt as well. And if people are happy putting 3 years fixed deposits, I've been very surprised. People want 3 months in debt. Why not 3 years in debt? And in fact, even the income tax rule says that invest for 3 years in debt. So I think these are the 3 starting points I would think about at this point of time. And I think at ICICI Prudential, we have focused on this. Actually, we have done something different. What we have done is we have created a fund of fund bouquet. And we have said that you can actually invest in a fund of fund bouquet and leave the entire decision making to ICICI Prudential. And we have created a number of products in fund of funds where you just leave the entire job to us, just invest in any one of the fund of fund bouquets and leave it. And in this conversation, we are not going to talk about products. So I'm not going to name the products.
Sure.
But I would say that's the fourth model that we have thought of, because we know that investors are confused where to start with. And that's how we've looked at it.
It's very interesting, Naren, that you've talked about debt mutual funds, because, you've always been seen as a person who's a master of equities. And I also agree with you that I think the focus has been more on equity when it comes to mutual funds than on debt. And in a country like ours, where there is lakhs of crores lying in fixed deposits, the offtake from retail in debt mutual funds has been relatively less. But tell me, in an environment of interest rate hikes that we are seeing right now, both globally and in India, what are the implications of this, of course, for savers it's good news. FD rates go up, so they feel, let's just keep staying in an FD. But from a debt mutual fund investor's point, what are the implications of these interest rate hikes?
It's amazing, if you had asked this question 10 years back to me, I would have been nonplussed. But, the way floating interest as a category has come up, if you're taken a home loan, you get home loans at very low rates. But, if interest rates keep going up, the home loan rates do go up because many of them are floating rate home loans. Like that, today we have a floating interest as a category. So what happens is you invest in this category of funds. As interest rates go up, you're going to get the benefit of this interest rates going up. So we believe that this entire category of floating interest category will be the biggest beneficiaries of interest rates going up. And we have found it so difficult to communicate to people that mutual fund industry is not going to be the loser if interest rates go up always on the debt side. Because the mutual fund industry, thanks to the regulator, has created products like floating interest also. Whereas interest rates go up, the coupon that you're going to earn is going to go up along with the interest rates going up. And we feel that that is the category, that is the only category which clearly benefits in the short run out of interest rates going up. And we find it very, very interesting to recommend to all kinds of investors that this is the category to look at and where you don't need to worry about interest rates going up.
Let's talk about equities and the equity market, Maren. One of the big features of this year has been a fairly large-sized pullout by foreign portfolio investors. And I think when we used to speak 20, 25 years ago, one used to hear you say, that it's the foreigners who are coming and owning Indian equities and making money, and not the domestic retail Indian investors. That seems to have changed now. Indians are investing, Indian retail investors are investing. But at the same time, from an equity market point of view, when you see a 1,70,000, 1,80,000 crore flying out, what kind of indication does that send? What are the implications of that according to you?
I think it's been extraordinary. Someone had come and told me that more than 2 lakh crores will be sold by foreigners and there would be so much of buying by locals to take care of the selling. I would not have believed it even 18 months back.
Yeah.
And I must say it's been extraordinary. Having said that, see, we are believers that in the long run, the foreigner will come back to India. Maybe even in the medium run, they'll come back to India. So I don't think we need to fear that. I think what we need to fear is whether in the near term, they will continue to sell so much that the Indian retail investor will also change his or her view. And this is a worry we have. And we don't worry about it as far as large cap stocks are concerned. We worry about it more on the mid and small cap side. And this is a worry we have. And we think that, as long as investors have followed asset allocation, I don't think there's much to worry. But if people are leveraged, as I mentioned initially, I think the worry is bigger. And I think at heart, what we've learned is being disciplined is the key to making money in the markets. And if you go back and look at the equity market conditions in US in 2021, there was just too much of indiscipline. All the loss-making companies were managing to sell their stock at unheard of high prices. There was a phenomenon called SPAC, Special Purpose Acquisition Companies. They all managed to list. It was like you didn't even know what you were going to do and you managed to collect money. And the kind of stocks which managed to list in USA in 2021 was a sign that the markets were overheated in USA. So that's why the markets have corrected much more in USA than they have collected in India. And I think discipline is always required on the part of investors. And why asset allocation works is asset allocation is discipline. And asset allocation is not easy, because what asset allocation tells you to do is, in a bullish year like 2021, it tells you be cautious in equity. It tells you in 2007, be disciplined and be cautious in equity. In 2008, when markets are crashing, invest in equity. So as long as you're disciplined, you're going to make money over the next 10 years, 20 years, 30 years. Are you going to be capable of being disciplined? Are you not going to be disciplined? That's the question. Markets are always there to make money for you in the next 10 years, 20 years, 30 years, with the exception of the Japanese stock market, which has not delivered returns for the last 30 years. Almost everywhere in the world, if you've been disciplined, you've made money. And the secret is discipline, not knowledge. Knowledge today in the internet world is very easy to get by. And how disciplined are people going to be? Are they going to get suddenly leveraged? Are they going to buy companies where there is no earnings, where there is no potential? Are they going to buy loss-making companies at ridiculous prices? These are questions which are not easy. And, even for fund managers, it's not easy. 1 year back, the pressure to buy companies which were trading without any profit track record was not easy for us also. Now it's much easier because all those companies have collapsed. But a year back, I can tell you it was not easy. And that's why investing is more about discipline than about knowledge. Knowledge was very easy even then, that these companies were loss making. But you have to get used to being disciplined. And the biggest learning that we have over long periods of time is discipline. That's why some of the best investors in the world have been Charlie Munger, who is 98 years old, and Warren Buffett, who are 90 years old. And what they have taught to people like us is discipline. I don't think there is much more that we can learn. And the kind of clarity of thought that they have at that age comes out of discipline. And you have to hear some of them speaking at the age of 98. And you can see in the form of YouTube videos, the kind of clarity they have at their age. It puts younger people like us to shame, if you ask me.
Naren, let's talk a little about one of your favorite subjects, which is compounding. And it's fascinating that the Indian mutual fund industry, there are quite a few schemes, many managed by you in your long journey in the markets, where I know we cannot benchmark past returns with what future is going to hold for us, but have given a 20% plus, sometimes even 25% compounded, growth over 20, 25 years of their existence. And that's fairly fascinating, isn't it? That while we tend to focus so much on the here and now, and yet some fund managers, and I don't know what your experience has been, have actually told me that, very few investors stayed through this whole journey, of those 20, 25 years and got those kind of returns. So that kind of also, brings to the point which you just made about discipline.
Exactly. But, somehow, it's very nice to say you get 20% per annum over long periods of time. And, when I joined ICICI Prudential Mutual Fund in 2004, we used to have 2,000 crores of equity assets. Today, equity and hybrid is more than 2,25,000 crores. So, these kind of compounding has been amazing. Forget the returns, which I don't like to talk about. Even the assets have compounded significantly. But what we believe is past returns are going to moderate, because way back in 90s, interest rates were much, much higher. Today, even the interest rates you can get are much, much lower. So people have to expect much, much lower returns than before. But our view has always been that as long as you're disciplined, you'll earn a lot of money. And forget whether you earn 20, you earn 15, you earn 10. You'll still earn a lot of money by being disciplined. And why unnecessarily give outstanding numbers like 20, because I don't think we should give these kind of numbers and get people to think that they will earn 20%. That is the past.
No,
Because I would say, there have been periods in my investing career like 94 to 2002, where that 8-year period was really bad. And if you looked at that 8-year period, people would have never believed you will get this kind of returns. And on the other hand, if you looked at periods like 2002 to 7, 20% per annum looked too low. So we have had periods of time when 20% per annum looked too low, and there were periods of time when 8% per annum looked too high. So I would say that as long as you're disciplined, you're going to make money. And that's what the mutual fund industry and what ICICI Prudential and many other entities have been trying to do. And the way the regulator has allowed us to launch many interesting products, particularly, and we have interesting frameworks like systematic investment plan, systematic transfer plan, booster STP plan. All these things are very, very interesting for the investor. And the ways in which, you can today transfer money thanks to the ease with which transfer of money is possible compared to what was possible in 2004, has also made it very, very easy for investors to invest in mutual funds. So I would say,
just to clarify, Naren, I wasn't saying that people will get 20% returns in the future. What I was trying to say is that the fact is that many schemes have delivered that much consistently over 25 years, and yet, because of lack of discipline, many people did not get those benefits because
that's true. That's true. Because that's the reason we came up with categories like balanced advantage, because investors invested in 2007. They didn't invest in 2002. People didn't invest in 2013. People invested in 2017. So the reason why we came up with categories, if you looked at March 2020, that was a fantastic period to invest. But how many people could invest in March 2020 with a national lockdown? So what we realized was we need to create strategies where automatic investment happens in market falls. And that is what we realized over a period of time, that it's so difficult to get people to invest in big bear markets. And that's the power of asset allocation. That's the power of categories like balanced advantage fund, which happens. And that's the framework that we believe in. Whether you get 20 or 15 or 10 hardly matters, as long as investors get a good investing experience.
Naren, in the last couple of years, if you see, there's been a very big spurt in the number of Demat accounts being opened, a lot of young people coming and investing in direct equity, on their own, picking stocks, crypto, which is, especially with the young people, become a bit of a craze. Does that worry you? What would your advice to young people who are listening to you be in terms of wanting to pick stocks themselves, or allow somebody like a Naren with 33 years experience to pick stocks? Maybe it's more exciting to do it yourself. But what would your advice to young people be?
I don't worry about equity cult becoming bigger is a great thing, as long as investors know what they do. In 1992, there were so many investors who got caught in Harshad Mehta wave and lost money. So they were not disciplined. In 1994, many of them invested in wrong category of stocks and lost money. So as long as investors are disciplined, I think the equity cult is a great thing. And the whole system, which I would say, thanks to the regulator, NSE, BSE, NSDL, CDSL, the payment systems, the internet trading systems, everything is so good. But finally, the investor has to have a good investing process. What we try to do as a mutual fund is create a good investing process, which finally delivers a good investing experience. If they have a good investment process, it's very good that they go direct. But if they don't have a good investing process and they lack the skills for it, I would say they should come to a mutual fund. So, that's how we look at it. So I think there are people who should go direct. There are people who should come through mutual funds. So it depends more on the person rather than, a blanket no or a yes. And I believe that, there are people who have the skill sets to do the investment directly. There are people who don't have the skill sets to do it directly. There are people who don't have the temperament to also do it directly. There are people who have the temperament to do it directly. So it all depends on the skill sets and temperament. And I believe that there is no flat answer, which is either no or yes. And and because I spent 10 years as a stockbroker in my 33 years of investing, I think possibly I'm better qualified to answer this question than many other mutual fund managers.
Naren, one final question. If you look at the next 3 to 5 years from now, are you bullish on the India story?
Clearly very bullish on the India story. But having said that, I think there is how the central banks handle the current inflation and all the associated problems with having printed so much money across the world and the associated geopolitical problems that we are seeing at this point of time in Ukraine and Russia is a complication whose impact we are not able to measure. So while the India structural story for the long term looks one of the best in the world at this point of time, what are the short-term hiccups and what are the problems which can arise out of the short-term hiccups? We find it difficult even now at ICICI Prudential to exactly estimate. So the long-term structural story with short-term hiccups whose impact is difficult to estimate is the actual situation. And that is why, we have become so big believers in asset allocation, because that protects the downside while not diluting the upside fully. And that's what we've been trying to say over the last 1 year continuously.
Always a pleasure talking to you, Naren. Thank you so much for joining us and sharing your wisdom, your insights. And I'm sure, like always, these are very useful for viewers. Thank you very much, Naren, for joining.
My pleasure. Thanks, Vivek.